Hello and welcome to Trading Growth and Value Stocks. My name is James Boyd. We welcome all of you here today. We got many of you. We got TMTM, Helen, Dom, Fayez, Mark, Elena, and many others. Welcome to all. Now, also a quick reminder, this is the afternoon for NVIDIA's earnings, which we'll take a look at, of course. And we'll kind of talk about why is that such a big deal for the stock itself, but also where the semiconductors are, and obviously how it relates to technology in the NASDAQ. Okay, we'll talk about that. Now, just real quick, as we normally do, I sent to you a playlist. And so if you go to this link right here, which I'll send to you, it is the playlist for this class, okay? So you don't have to kind of write everything down. You can actually go back and get the recordings of prior classes that we actually had. And also, of course, you can follow us right on YouTube as well. And if you have not subscribed, you do so. It's free, okay? Now, a quick reminder that as we get started here today, remember that when we talk about trading growth and value stocks, that might be for some that the investors are maybe doing bullish trades. We know that you can do a bearish stock trade as well. We won't really get into as much of that here today, but I'll kind of mention a little bit. But mainly we want to try to focus maybe more on, let's say, bullish examples. But from time to time, we'll talk about bears if we see one. Now, also remember when we talk about examples and provide information, information is provided for general informational purposes only, should not be considered an individualized recommendation or endorsement of any particular security or investment strategy. You get to choose for yourself. Now, also remember when we talk about examples, we will do that in the Paper Money software application. Investing involves risk, including loss of principal. And as always, we want to kind of have a set agenda of what we really cover. So first off, I want to kind of talk about things from a technical standpoint, like support levels, moving averages. And the second thing I really want to kind of cover in the current market is, what about some fundamental areas, okay? What are maybe some stocks that potentially have some value, okay? And maybe what are some stocks that are actually getting closer to that value zone, okay? So that's what I really want to talk about here today. And so we're going to talk about things from a technical point of view, but also a fundamental point of view. Why are we doing that? Well, because last week we talked about the examples of going back to, if you go right to schwab.com, okay, so go to schwab.com, log on, and if you go to where it says learn, you're now going to see where you can go down to courses, okay? So if you went to, just like we did last week, go to learn and then courses, what you're now going to notice is the second course down, courses right there. We went to learn and then courses. Second one down is our class, which is stock investing with fundamental analysis. Now, if I click on that, you're now going to see the lessons that we actually talked about last week. Now, if you scroll down to the bottom, two things that we're going to actually go back again and look at. As we scroll down to the bottom, there's also some resources, okay? And you're going to see that, where are they? Well, they're in the online course, okay? They're at the bottom. Now, two things we actually see, stock investing fundamental analysis. It's a sample plan. We're going to reference that. And also you're going to see something here when we talk about the intrinsic value calculator. We're going to look at this a little bit as well and talk about some examples that might be some stocks that might be kind of getting more attractive, as many stocks have actually had prices fall on some examples. Now, if we talk about this, I want to just kind of bring up just briefly let's start off with, first off, the NVIDIA example, okay? So NVIDIA, very important here. We probably all know why, okay? It's been a big catalyst for the NASDAQ and other stocks. And the biggest actually thing is, when we look at where it is, it's kind of just sitting on this ledge of support. Now, we can see where it is in the after hours. It's sitting here about 130 and change, okay? So the biggest thing is NVIDIA is kind of like right on this plank of support, okay? And if you go and take a look at just real quick at semiconductors also sitting on the plank of support. Now, if you talk about NVIDIA, you talk about SOX, I think you'd have to bring up also a little bit of the NDX. And if you look at the NDX itself, what you're going to see is, we just try to make this as simple as possible. If we see that the price is below the moving averages, we just don't have an entry set up yet, okay? So when I look at this shorter term moving average, it is still red. It doesn't matter where it was this morning. It doesn't matter where it was in the middle of the day. All that matters is the color of that line of the moving average. So it can start up in the middle of the day, it could be up. It just matters, did that color of the line change? Now, below that, we can start to get maybe like divergences, W patterns, V patterns, all above. Those are all things that could probably increase the chances of getting that moving average to turn colors. Noted, okay? So when we look at, let's say, the NASDAQ right here, we just don't really see it turning, the keyword is yet, but the prices has fallen down near this support area. The support area on the NASDAQ really being 21,000, okay? Now, SPX, just briefly, is still in the middle of the range. The bad part, I mean, just being brutally honest, the bad part of what we see in the SPX is we had not traded or closed below 59.80 for a while. We got down below there. Bill, was that you? Was that Bill putting in the sell order? Maybe it was, okay? Backing up the truck, beep, beep, beep. Okay, and unloading, I'm joking with Bill, of course. But the biggest actually thing is we saw sellers outweighing the buying effort. Why do the markets actually go down? Well, because there's more sellers than buyers. It's not to say that there's not buyers. Just think of like a scale. There's just more sellers that are selling than buyers that are buying. And why is that? Well, they might think that the technical levels are breached, like support or the moving average. They also might look at the moving average colors themselves and say, those aren't green, those are red. And when the moving averages are red and the price below is down below those moving averages, price tends to drop. So it kind of tells us what we already know. The hardest thing is being patient and knowing what the investor is waiting for. So speaking of that, what is the investor waiting for? Well, they might be actually saying, look, I'm kind of waiting for the price to come down to 58.77 where I'm expecting more buyers to come in at, or that's technically, they might be thinking I'm looking for the prices to come down to some longer term moving average, maybe like a 30, 50, 100-day moving average and so on. Or they might be looking for some stocks that are looking fundamentally attractive. And we'll show that in just a moment. Just want to take a quick look real quick as if NVIDIA's come out. If you see something, let me know that it announced, but I don't see a whole lot of action yet. So we'll come back in just a moment. Okay. Now, yeah, the comment is, now Alan does bring up a point that CRM, Salesforce, down in the after hours. And I want to kind of point this out. So whenever the company announces the earnings, you can get the reaction, of course. They haven't had the conference call yet. That could totally change, okay? Analysts could ask questions and kind of maybe get a little bit more clarification on what was stated, et cetera. But the initial reaction is negative so far. And that's not one we've necessarily been talking about. We've been kind of looking at more NVIDIA, but this is kind of another one where it's kind of like putting a wet blanket, if you will, on the NASDAQ, okay? Now, I want to kind of first off, just real quick, go to so if you see some movement on NVIDIA, let us know. We'll come back to it. But I want to kind of start with just something real quick, and I want to look at Apple. Now, today we had a little unusual day. We saw new tariffs, okay, from the Eurozone, that if we import their products, it would cost 25%. So more tariffs. So not just Canada and Mexico. Now you got European tariffs at 25%. Okay. So now, if you take a look at this, I want to kind of go back to it. And we'll talk about how that's playing into, let's say, Apple in just a sec. But if we take a look at this, we're going to go back to this section, okay? And we're going to scroll down at the bottom, okay? If you scroll down at the bottom, the intrinsic value calculator, I want to bring up an example, and I want to start with Apple first, okay? Now, what I'm going to do is I'm going to pull up this sheet, okay? Now, this sheet, do not be worried about this and say, James, I absolutely cannot stand Excel. Don't worry, Excel is wonderful, okay? And I'm going to guide you through it. Now, first off, this is really done for an example, and I'm going to kind of talk about what are some things that are built into this. So first off, I have Apple here, stock symbol, okay, just typed in the symbol. And then I like to kind of start at the bottom, okay? So what you're now going to notice is we just have stock price. And I typed in where we were probably about 15 minutes ago, $200.43. So you could kind of think of this like we're weighing some of the fundamentals. And then we're trying to get an idea based upon where the company has been in terms of its fundamentals, where it is now, and where it might be going. What could it be potentially worth? When we say that, we're really saying what's the potential intrinsic value. Now, what you're now going to notice is when we say stocks EPS, earnings per share, and right above that in parentheses it says TTM, or trailing 12 months. That just means the last 12 months or 4 quarters. What did they put out? They put out 696. Okay. Now we'll talk about that. So let's just hit this now. When you look at earnings per share and you look at stock price, if you took earnings per share divided by stock price, you get what's called earnings yield. It's the same thing as doing like if you took the dividend over the last 4 quarters, divided into the stock price, you would get dividend yield. Now, a lot of people like to look at dividend yield in terms of valuation, or is it attractive? Some investors, okay, like to look at earnings yield. Earnings yield is just EPS trailing, okay, last 4 quarters, divided by the current stock price. Now, I'm going to come back to this in just a sec, but when you look at years of projected growth, we're just going to put 2, and I'll talk about how we can vary that in just a moment. Now, you're going to see 4 letters here, CAPM. That's not a stock symbol. That's capital asset pricing model. So this is like a model. It's called a single factor model. And it's just using the company's beta to try to get what they call an expected annualized rate of return. Now, when you take a look at this stock beta, I like to think about like this as like a stock volatility score relative to the S&P 500. So where do we find that? Well, I'm going to go up to the trade tab right on the Thinkorswim platform. And what you're going to notice is I have Apple brought up here already. Okay. So here I got Apple. Now what I'm going to do is I have a little caret there where I can drop it down or close it, okay, or expand it, close it right there. And you're going to notice all the way over to the right, we see beta and it says 1.149. Now, right above this, what you're now going to see is if I click on that lightning bolt over here to the right-hand side, it's going to also give us a row here on the left-hand side, calculation. Now, I just want to kind of show you the difference, okay? So when we talk about the difference between beta, like a standard beta or a fast beta, we're going to click on that little question mark. And this, when you look at a standard beta, it's just using the last 5 years. That's the duration, okay? When you look at a fast beta, it's just looking at the 1 year pricing data. Now, in our examples, we're going to use the fast beta. 5 years could be a long time, so could 1 year. So we're going to use fast, which is just using a 1 year duration. If I click on apply now, okay, and it's now going to tell me that the beta is 0.59. Now, again, if I click on that and try to get a little bit more idea of what is that telling me, it's really telling you that it's really best used in context of securities with longer and more consistent trends and cycles if you want a 5 year. But when you look at the beta of the S&P 500 is 1. So if you saw a beta of 0.59, what is that telling us? It tells us that Apple, the stock, historically in the last year has been less volatile, okay, than the S&P 500. Now, if we chose a stock, maybe like a gold stock, a steel stock, or whatever, you might see, or maybe SMCI, you could see stocks with very high beta scores. You could almost think of it like beta, like a stock volatility score, but relative to the S&P 500. Okay. Now, what I'm going to do is I'm just going to type that in right there, 0.59, and I'm 0.59. Now, when you think about the historical returns in the market, that does not mean it's going to be the future. Normally, if you include dividends, you're thinking like 10.8%. I'm going to be a little bit more pessimistic. I'm going to say that the returns in the market going forward are not that rich, okay? I'm going to make it lower, okay? So when you say expected stock return, we're talking about the price return and the dividend on the S&P 500. The 10-year treasury, the risk-free rate, 43.51. We want to type in 43.51, okay? And what it does is when you type that in, it puts that 4.35. That's the annual rate for the 10-year. And what it does is it gives us the expected annualized return, okay? Now, the last two things it asks us for is it asks us for the expected growth rate going forward. Now, you know on Schwab.com, they'll give you a 1-year growth forecast. They'll also give you a 5-year forecast. And what you want to kind of understand is over here on the right-hand side, it's telling us that we're looking for a 5-year. Now, this could be good or bad. We'll show that. And the last thing is we're just looking for the PE, okay? Now, I've historically kind of gone more over this. The point of this is not to go super deep on this, but I want to look at more examples here today. But I want to kind of just show us where can we find those two pieces of data. So if I go up to the very tippy top, type in Apple, and then what I'm going to do is I'm going to kind of back this off so we can see it a little bit more normal, scroll down. And what I'm going to do is I'm just going to scroll down. And now what you're going to see is the information like we normally look at, like dividends, earnings, historical earnings, peers, and ratio comparison. Now, when we get to this section, I'm just going to say show more. Click. Now, when we get there, the first thing I want us to kind of see is we're going down and we're really looking for what's the earnings per share growth rate going, the key word is forward. So when we scroll down and we look at this, we're not looking for sales. We're looking for the earnings per share growth 5-year. So what you're going to now notice is in the next 1 year, they're really expecting 8.33. Over the next 5 years, they're expecting 17.83. That's where I got the number, okay? Now, by the way, when you talk about looking for companies that might have, let's say, a strong trend, investors who are looking at this are really making sure, do these companies, is there a forecast for growth even? Now, if we go up to the very tippy top, you're going to see that right here, company comparison, we want to go look at index comparison. If I click on index comparison, it's going to tell me like what the PE, let me show that again. We are on company comparison, just go to index comparison. If I click on that, you're now going to see that gives us the PE for Apple, and then compares that to the sector, then compares that to the S&P 500. Now, what it's asking for is what is the PE for the industry group / sector. That is 46.83, and that's why that number is right there. Now, so it's kind of looking for a couple things. If we kind of think about how many data points is it looking for, 5, 6, really like 6 data points. The stock price and the years of projected growth, not really data points, but just kind of what it is. So it's really looking for 6 data points. Now, what you're now going to notice is it tells us, here's the stock price, here's the intrinsic value, okay? So don't worry, we're going to do a number of these. And you're going to see what we have right here is called a margin of safety. Now, does every stock, let's kind of first go over this, like what's the lingo, okay? So if I said, let's kind of start with this one. If I said in this case that the stock, okay, and I'll just speak to it. If we said, for example, that the stock was trading lower than the intrinsic value, we would call that it's undervalued. And the way we would actually kind of look at that is it's also trading with a positive margin of safety, meaning the stock is trading 13.7% below what the intrinsic value is, given its current fundamentals. Now, if we flip this, okay, so some investors might say, hey, that's potentially undervalued. Now, if the stock price and the intrinsic value were the same, they would say it's fairly valued, and the margin of safety would be 0 because the price and the intrinsic value would be the same. Now, flip that. If we said the stock price is higher than the intrinsic value, you'd say the stock is overvalued potentially and trading at a premium, okay? The opposite of that would be a discount in our first example, trading at a premium, or we would also say in this case, a negative margin of safety. So if I said, hey, the stock of Apple is $300, you're going to see it's not going to have a positive margin of safety, meaning the stock was at 300 and the intrinsic value was 278. It's 7.6% above what the intrinsic value is, okay? Now, if we kind of said to ourselves, so what is really intrinsic value? It's taking its current fundamentals and saying, based upon its current fundamentals, theoretically, this is what the stock could be potentially worth. I'm talking about the equity, okay? Now, if you take a look at this, we want to go back to the chart for just a second and just take a quick peek. Now, if you look at this, what you're now going to notice is it dropped, okay? And let's kind of just say in this case, if the stock drops further and further down, and let's say it drops down to 230. Now, does it become worse or better? Good question. If it comes down to 230, what you're now going to see is if the intrinsic value is, let's say, 278 and the stock price goes down to 230, the stock really starts to become more attractive fundamentally, potentially, but also as you technicians out there, it kind of also becomes a little bit more attractive technically. It might be oversold on the stochastics, the RSI, the whole 9 yards, and there might be a divergence, and we've fallen back down to a horizontal support level. So when prices are dropping, people might be licking their chops on both sides, technically and fundamentally. They can see where the horizontal support levels are, but they can also see it in terms of, is it trading at a potential discount, price below the intrinsic value? And does it have, when we say that, we're saying it's a positive margin of safety. Now, so when prices drop, the investor needs to kind of control themselves, because if the prices drop, that's not necessarily bad unless they're only in it yet, that they're under pressure. But the biggest actually thing, it might be something that where it could bounce. Now, if you go back to many of these stocks, most pullbacks were an opportunity. Not all, most, okay? And when we say most, which ones were most? The ones that had some fundamental drivers. Okay, now, I want to kind of go to a different stock for just a quick second, but I want to see if there's any questions. Okay, now, thank you for that. You said NVIDIA now. Now, I'm going to, without even, I'm going to kind of think that there's going to be pressure to the downside. I want to see the price. It wouldn't be surprising, given kind of the bear sentiment we have in the market, a little pessimism, okay? So now if I kind of move my arm, we're just kind of trading slightly flat, kind of a neutral reaction so far. If this market's going to bounce, I think the catalyst probably has to come through NVIDIA to see, is there still a real demand for that demand, the product and service of AI, and will those companies keep investing like they have, okay? Now, we'll keep an eye on that. Thanks for the heads up. Now, if I'm going to go to just a quick example, we did this example 2 weeks ago, and we talked about PG, okay? And the stock really, the very next day went down. And this is kind of where you want to kind of have an understanding of technically, where do you see support, okay? Second part is, what do you see in terms of the fundamentals? Now, let's do this fast. I think when you do this and you become better and better and better, it's probably going to take you 60 seconds to really find out the numbers. So first thing I want to know is 171.30, okay? So I'm going to type in 171.30. There it is. Now, I need the stock's earnings per share. If I go to look at the stock's earnings per share, company comparison, I'm just going to take that stock out, type in PG, Procter & Gamble, and I'm going to just make sure that that says Procter & Gamble, and now we have that information. Now, since we're just kind of right there by index comparison, I'm going to click on that. And that index comparison, we got a 27.44, okay? And just since we're so close, I'm just going to use it, 27.44. And the last thing we need there is I'm just going to go down to that earnings per share growth rate. Now, I want to show you some differences here, okay? Now, if you look at the earnings per share growth rate over 1 year, 5.12, but we're looking for the five year, 33.29. Go back, 33.29, okay? Now, that's a pretty big number. Now, the biggest thing you need to understand is this sheet automatically, the higher it is, the more it reduces it. Why is that? Well, it's called mean reversion. If something is really high, the next period is how hard to get that same percentage growth. So the higher it goes, you're going to see that it's already reduced it by 20%. Okay, and there's reasons for that. But what it does is it lowers the projected growth rate. It's saying that if it's that high, it's highly unlikely that it's going to do that the following period and the following period and the following period after that. Just kind of becomes mathematically harder and harder. Now, if you look at the stock beta, we know where that's at. And if I go to PG and say, what do we got? I got 0.09. What is this telling us? It's like not really that volatile, okay? Beta of 1 would be like the S&P, and if we got a fast beta of 0.09, okay, not 0.9, 0.09, this is kind of more benign, like to what the market does. Now, that does not mean the future is going to be like that, but that's in the last 1 year. We don't have to change this. We don't have to change that. And the last thing I really want to find out in this case is what's the stock's earnings per share? Well, last but not least, go back. And if I look at that stock's earnings per share, pull that back up. And if I did that, I could have found it on that page too, but let me just reload it. If I want to show you another place where you could find that stock's earnings per share, when you scroll down, it's going to also show you that on the main page, historical earnings. It's also right there as well, 628. Now, let's speak to this and see what we have, okay? Now, the reason why I kind of talked about this 2 weeks ago, okay, is I like to kind of update these. I look at probably 30, 50 stocks, track them weekly, and I like to look at where they are technically and fundamentally, and you probably like to do the same thing. Well, one of the stocks that was trading, okay, below its intrinsic value, also at maybe a support area, was Procter & Gamble. Now, I kind of also want to kind of look at this. So we have the intrinsic value at 214, the stock price at 171. The margin of safety, 20%. What does that even mean? Well, that means the stock is trading 20% below theoretically what it could be worth in terms of the shares, okay? Now, when you talk about this, let's kind of talk about significance. If we said the stock had a negative margin of safety, okay, 5%, plus 5% margin of safety, you'd almost kind of say that that's really like almost trading near fair value. When you start kind of getting, let's say, a negative margin of safety of greater than 10% to a positive margin of safety, let's say 10%, now we're starting to go out what fundamentalists call valuation bands, okay? So it's not significant if we say, oh, it's trading at a premium or discount of 2%. Not really super significant because these numbers can be very sensitive, okay? So usually people that do this, they're going to say, look, I want to see something statistically significant. Find me something that's trading at a premium of greater than 10%, then we might say something like it's overvalued more. Or find me something that's trading at a 10% plus margin of safety, okay? And that's more statistically significant, okay? Now, what you're going to see in this case, trading at a 20% margin of safety. Now, does that guarantee the stocks can go up? No, okay, it doesn't. Stock can go down like it did 2 weeks ago, the very next day. Now, I want to point this out, that when there's people that probably watch this, that when the stock goes down, somebody the very next day was maybe watching this, and it got hit with some news, and they said, my gosh, thank you very much. Now, if I go back for just a second, just a couple days ago, barely over a week ago, the stock was at 162 and change. Well, when that stock was at 162, was it worse or was it even a little bit more interesting? Well, if the stock's at 162, the intrinsic value is at 214, it had a 24% margin of safety. Okay? Now, some investors might say, kind of interesting. Now, what we're talking really about, remember when we said earnings per share divided by stock price, that's earnings yield. Okay? Now, if we're talking about dividend, last 4 quarters or year, divided by the stock price, that's dividend yield. Okay? So what we're really talking about, what's driving the intrinsic value is not dividend. What's driving the intrinsic value is earnings per share and the growth rates going forward. Okay? So here, this is not a dividend discount model. This is a model based upon trailing earnings and what's the forecast going forward. All right. Now, so now, Michelle, this is a great question. How much, now here's what I want you to do. Okay? So let's say you said, hey, James, when I did stock beta, I did a fast beta and I did 0.09. So let's go back and just quickly look at this, okay? So I'm going to use the stock price, go back to what we had. And this is a great question. This is exactly what I wanted you to do. So Michelle, you get a bonus point, okay? There's more stickers for you coming. 171.30. Okay. So the question is, if we kind of change that just a hair, smidge, how much is it going to change the margin of safety? Well, let's go take a quick look. Now, if I go back to the trade tab and say, I want fast beta, I want the calculation, and I'm just going to go standard, which is a 5-year measurement, okay? 0.3952. Now, I'm going to probably say that it ain't going to be much, okay? So if we looked at this and said 0.3952, how much does it really change it? Answer, it changed it by a whopping 2%. Not significant. Now, the question now becomes, well, okay, fast beta or beta in general did not really materially change margin of safety. But what would? Oh, okay, what would? Earnings per share, because that's going to affect the earnings yield, okay? That's a starting point. The second thing that's really going to also affect it is the growth rate going forward. If we said the growth rate was only, let's say, 10%, well, if the growth rate is only 10%, that margin of safety dramatically changes. So if we go from 33 down to 10, the margin of safety collapses. It goes from being positive to negative. So do you now understand when kind of the companies come out and say, hey, we're having to slash the forecast of earnings per share. We're having to slash the revenue forecast. When they say that word slash, what's going through those fundamentalists' minds is what was a positive margin of safety is now probably flipping negative. Now, the technician's mind, they're probably saying, oh man, it's probably gapping down to support on high volume. Okay. Now, what I want to do is I want to go back into this. But so, by the way, this is why, Michelle, you just walked kind of right into the booby trap, okay? If one of these numbers, like beta or something like that, can change a number, the final number by 2%, that's why you're looking for things that are more significant, okay? You're looking for things that maybe have a margin of safety greater than 10 if you're talking about something undervalued. Now, what I'm going to do in this case is I'm going to set a buy stop order, okay? So a buy stop order says, look, buy the stock if we get at or above today's high, okay? So what was today's high? Well, today's high was 172.65. Now, if you don't mind, there's no, back-tested number, but I'm just going to kind of say in this case, what was the high? I'm going to say 173. I'm going to go buy custom with OCO bracket. And I'm going to say, look, if you can get to 173 or higher, okay, buy the stock, okay? Now, some people don't like this because, well, if it goes to that price or higher, there's no ceiling on what it could buy up to. Well, what could we do? Well, we know we can change that stop order, and I'm not going to sell. I'm talking about the buy stop. Buy it if it goes to that price or higher. We just change the stop limit. So in this case, we'll say, look, if it goes up to 173, buy it, thinking it could go higher, and we're going to place a cap on what we're willing to buy it up to. And what I'm going to do is I'm going to say, look, there's a window there. The stock needs to go to 173 or higher, but it can't go any higher than 173 and a quarter. Okay? So it's allowed to buy up to 173.25, but not any higher. Okay? Now, what I'm going to do is I'm going to go back to this target here. And if we go back to that prior high is really right about 180. Now, it's really about 180.30 or so. And I'm going to put that 180 right there. And if we said, hey, we're going to set that stop underneath where the breakout level was. Well, we take 169.35, okay, less 2%. And what you're now going to see is 165.96. 165.96. Okay. Now, I'm just going to leave it right here, 100 shares, and I'm just going to change it data GTC, data GTC. Good till canceled, in other words. So target and then stop. Now, what I want to do is I want to kind of show you some different type of stocks. Okay. So first off, I want to go back to two other stocks that we've probably, looked at. Okay. And I want to go back to a stock that yesterday fell off, a cliff. And I want to look at, and by the way, that stock is Amazon. The second stock we'll also take a look at is Meta. And let's kind of look at some comparisons, okay? Now, what I'm going to do is we'll leave that there. Any questions on that, let me know. Yeah, Dean, that's true. It's adding to the position, okay? True, yes. So now what I want to do is I want to bring this back up for just a sec, okay? We're going to come back to this. Let's try to do it in a minute. Now, instead of me talking through it, just watch me do it, and let's just kind of see about how long it will take. So first off, we're going to come up to the stock, and I'm just going to reload. Let's start with Meta first, okay? So we got Meta, and we know that stock is trading at 671.30, okay? So 671.30, okay? Stock's earnings per share, pull down to the historical info, 24.16, pretty high number, okay? But you also got to remember it's a $600 stock, 24.16. Beta, let's go back. What do you got on that Meta? You got 1.22. That's the highest we've actually seen. That's if you're using a 5-year score. If we want the 1-year score, which we're going to use, that number is going to be 1.0, mimicking the S&P. There it is. Now, if we're doing this so close together, we don't need to change these two numbers right there because the market's closed anyway. And the last two numbers we'll just find out. Are those ones right? Excuse me. Should have kept where I was. There you go. And just why we're here, let's go to index comparison, 32.27. And last number we need, scroll down. I'm just going to take a look. Now, this is kind of interesting to watch, okay? If we take a look at the earnings per share, sorry, I overshot it. And if we do that, and if we look at earnings per share, right there. By the way, that's underneath annual growth. Now, look at the differences, right? The earnings per share growth 1 year, 60. So do you see how when you look at one sector versus the other, they're not the same? Dramatically not the same, okay? This is why some people like discretionary stocks, communication stocks, tech stocks, because there's higher potential growth. Now, what's the problem with that? If they get it wrong, it could be really wrong. If they get it right, it might be amazing, okay? So you got to see that with a higher number, there's a greater risk of being off. Now, if you look at the 5-year score, it's still 30.29. Now, if we type that in and say, okay, what do we got? And we say, what do we see? Well, the intrinsic value of Meta, given its current fundamentals, is 816, and the stock price is at 671. And the margin of safety is really 17.8. Now let's use our technical minds and our fundamental minds. If we went back to the stock of Meta and just say, hey, where's Meta in relationship to maybe the technical lines of support? Well, when we look at this kind of line going forward, line going forward, line going forward, line going forward, and we just stretch it out to where it is now, we might say, look, if it came down perfectly and just kissed the support level, we might say 633. Let's say it comes down to 635. Okay, how low did it get yesterday? 641. And let's just use yesterday's low. So if we go down to 641 like we did yesterday, well, it just kind of means it has a higher margin of safety. Now you can rest assured that there's analysts out there, and they could be right or wrong, that are watching which stocks are attractive, not only in terms of a technical point of view, but also fundamental, maybe even both. Now, if it does come down to 641, which it was yesterday, it just kind of makes that margin of safety even a little bit more interesting. If you look at, let's say, 635, which is the horizontal support, it just kind of makes that margin of safety even a little higher. Now, the one thing to kind of remind, and just put a wet towel on this, it doesn't mean that other people are going to buy it. But the idea is if someone was kind of looking at this and understood what was going on fundamentally and technically, they might say which stocks could be supported by not only its past earnings per share, but also which stocks might be supported in terms of its forward estimated growth. Okay? Now, what we're going to do in this case is we're going to set like a buy limit order right here. When I say right here, I'm going to say 645. Right click on that line, closer to the technical level of support. We're going to go buy custom with OCO bracket. Okay? Now, what you're now going to notice is if I right click on the chart, where I right click, that's where the price that comes up right here. Limit dated GTC. Dated GTC on the target. On the upside, prior high, 733. This is going to be what we call a swing, or some people like to call it swing target. And then if we look at the downside, if we broke that diagonal support, which is sitting here about 631 or so, 631, less 2%, it's going to be 618.38. Okay, so those are the numbers. Now, when you do a limit order, you might say, I'm going to do this GTC. This is usually good for 180 days. Okay, you might put a timestamp on this or a cancellation stamp where I only want that good for the next 5 days. You can do that by going to that little gear right there. Target the prior high, good till canceled. Stop, good till canceled. Okay. Now I only got 5 minutes left. And this is where I love this, but the 45 minutes, it's like, it just goes by so fast. Now, I want to kind of just say something just real quick, kind of share this with you. So there's a little script, okay? Right click, edit form, customize. And there's a script that some investors really like to use, okay? It's called earnings yield. E for earnings per share, trailing, historically, divided by Y or stock price, okay? Now, I'm going to share this with you. And what this is going to do is it's going to really show you, and this is expressed in percent form. So if I looked at CRM, it's only telling us that the earnings yield is 3%. So when you go back and back test this in terms of which stocks probably have attractiveness or not, it's really the stocks that really have a higher percentage number. Okay, that doesn't mean they're going to go up, but the investor might start with stocks that have a higher potential earnings yield current percent than ones that don't. Okay, now what I want to do is I just sent that script out to you, and I will also put it in the description as you are watching on the recording. Now, I want to go back and I want to see if I can just take a peek, please, at one more. I know how you feel. Just give me one more. Okay. Now, I want to pull this back up, and if you don't mind, I'm going to I just want to see where Amazon's at. Now, the reason why I say, oh, I want to see where it's at, I don't can this before the class. Okay. And so what I mean by that is I'm not kind of finding which ones look good. I'm doing them right as we go. Okay. So what's the stock price? 214.83. Okay. Stocks earnings per share. Scroll down to the historical there. Now notice 552, not the biggest number. Okay. So that earnings yield doesn't look super attractive. That's probably only a 2% earnings yield. Beta. What do we got? So when I look at the beta, it's going to be on that one 1.28. Okay. Now you can see when you do this over and over again with two screens, I'm only using one screen. But if we did this just over and over again, and maybe even had another screen, you could go pretty fast. Okay. Sorry. Should have just stayed where I was. There you go. Now, first thing while I'm here, I'm going to go to index comparison. It's 35 again, 35.52. Earnings per share growth rate. Go to company comparison, scroll down. And what you're now going to see, there it is, 5-year, 36.89. Notice the 1 year off the chart, okay? So notice the difference between 1 year and 5 year. Why does the investor do the 5 year? Well, they're trying to smooth, okay, that if it has a high 1 year, it could inflate the intrinsic value. Now, I'm just going to show this, and we're going to wrap it up with a nice bow on it, okay? So if we looked at these numbers and said, wow, we really saw Amazon just plunge yesterday, and it went all the way down to 204. So let's just go back to where it was at 204 yesterday. Let's say it's at 204. Well, yesterday, now when you talk about really growth stocks, a lot of times you might not necessarily be able to buy them for a discount. They trade at a premium. It's almost like playing the board game where they have Boardwalk and Pine Avenue, or Malibu real estate, or Park City real estate, and so on. It's just very hard to really get those companies. Now, yesterday, Amazon did go down to where it was more trading at the intrinsic value. So For some investors, it might say that's even a victory that it can even trade at that. Okay. Now, I'm out of my time here today, but what I want you to do is I want you to look for some stocks that have some lower betas, okay, that are maybe trading at more of a discount, something with a discount of greater than 10%. Second, if you like some growth stocks, like we showed with, let's say, Meta or Amazon, I'm going to also include PanW there or Starbucks. Look for even some growth names that might be also trading closer to the intrinsic value. If the stock price and the intrinsic value are the same, that doesn't necessarily mean it's horrible, as long as there's maybe some prospects for that growth going forward. To get that to happen on growth names, you really need to have kind of some more pullbacks. And sometimes when the VIX goes up like it has, gives you those opportunities. Okay. Now, I'm out of my time here. I want to thank Connie for answering those questions in chat. I gave you a homework assignment to go into that online course, download that intrinsic value calculator, and practice running some of those numbers on your stocks, but also some new ones as well. Now, remember with what we discussed, it was done for example, illustration purposes only. Remember that coming back tomorrow, we'll come back right at 9:30 a.m. Eastern. Look to join us there. And this has been the class on trading growth and value stocks. Thank you, Connie, and thanks to all of you as well. Have a great afternoon. We'll see you back tomorrow morning. Take care. Bye-bye.